How do you do that without becoming a doom scroller?
You turn it into a checklist.
So no all in.
Almost never. You want repeatable. You want survivable. A portfolio that needs a dramatic event to succeed is not a portfolio. It's a bet.
Most people think big events move markets, but a lot of the time it's the plumbing underneath. Money flows, pricing power, and what gets used to settle trade. And that plumbing can change your portfolio long before headlines feel personal. Welcome back to The Passive Path. Today we're talking about a tricky idea: why the US dollar stays powerful even when the US looks messy, and what investors can do with that without falling into conspiracy thinking. To help us unpack it, I'm bringing in a fictional guest, an ideas character. He represents the worldview behind the source material we're working from, but he's not a real person, and we're not treating this like insider knowledge. Just a calm exploration of incentives, history, and investing implications. Thanks for joining.
Happy to be here. And I like that framing. If we do this well, listeners leave with mental models, not a new list of villains. We can talk about patterns without claiming we know who caused what.
Good. Let's start with the core claim. People say, the dollar is strong because the US economy is strong. But you're saying there's another layer.
Yeah. Think of the dollar as a tool the world uses, not just a reflection of the US. If a lot of global trade and debt is denominated in dollars, then even people who don't like the US still need dollars to function. That creates constant demand, especially during stress, because contracts and payments don't pause when sentiment changes.
So it's less about popularity and more about necessity.
Exactly. Here's a simple picture. If you borrow in dollars, you must earn or buy dollars to pay back. If commodities are priced in dollars, you need dollars to buy them. If a crisis hits, lenders tighten, and everyone scrambles for the default settlement currency. That scramble can make the dollar rise even if the US is part of the problem.
That sounds like a plumbing explanation. It also explains a confusing market moment. Rates drop, money printing happens, and yet the dollar can still go up.
Right. People assume more dollars printed automatically means dollar down. But in a panic, the demand for dollars can spike faster than supply. It's like umbrellas. If it's raining, the store can restock umbrellas. But if everyone rushes in at once, the price still goes up.
The transcript uses a dramatic analogy about someone betting on a low-probability event years in advance. What's the clean investing version of that idea?
Insurance and tail risk. If something is unlikely tomorrow, but devastating, if it happens eventually, smart actors prepare early. That doesn't require prophecy. It requires incentives and patience.
Give me a concrete example that's not geopolitical.
Sure. Think about a homeowner in a neighborhood that hasn't flooded in 30 years. Flood risk feels less than 5%, emotionally. But if the house is your main asset, paying for flood insurance can be rational, even when the probability is low. You're not predicting a flood next week. You're protecting a fragile balance sheet.
So the bet is really positioning.
Yes. The point is, markets reward preparation more than prediction. If you structure your life and portfolio to survive multiple scenarios, you don't need to be right on the exact storyline.
Now, the source material connects dollar cycles with wars and conflict. How do we talk about that responsibly?
We talk about mechanisms, not accusations. Historically, wars and sanctions can reshape trade routes, commodity supply, and alliances. Those shifts affect currency demand, inflation expectations, and capital flight. That's enough for an investor to pay attention, without claiming every conflict is engineered.
Mechanism first. What are the mechanisms that link conflict and the dollar?
A few big ones. 1. Risk-off flows. In uncertainty, global investors often park money in U.S. Treasuries in dollars because the market is deep and liquid. 2. Energy and commodity pricing. If oil or shipping routes are disrupted, prices jump, inflation rises, and central banks react. 3. Sanctions. If a country loses access to dollar clearing, it scrambles for alternatives, and everyone else reevaluates counterparty risk. 4. Defense and fiscal spending. Big spending can push yields and alter relative attractiveness.
You're describing how money runs towards safety.
Exactly. And sometimes safety is just the place with the biggest exit doors. The US market is big. If you're a global fund and you need liquidity fast, you go where you can move size without breaking the market.
Okay. Now the transcript spends a lot of time on de-dollarization. Countries trying to trade in other currencies. How should a retail investor interpret that?
Calmly and in layers. De-dollarization is real as a desire and as small steps. More bilateral trade, settled outside the dollar. More gold accumulation, alternative payment rails. But the dollar system is sticky because it's not just politics, it's a network effect. Contracts, liquidity, legal frameworks, and habit. So the question isn't, will the dollar die next year? It's what parts of the system might slowly diversify and what shocks accelerate that.
That's a better question, because people treat it like a light switch.
And it's more like plumbing renovations in a skyscraper. You can reroute one pipe, but you don't rebuild the whole building overnight while people are still living in it.
Now let's bring in the Buffett thread, because that's where this becomes investable. The idea is, some investors position early in boring assets, like oil, while everyone is chasing shiny themes.
That's the pattern. Whether or not you agree with every geopolitical interpretation, the investment lesson can stand alone. Energy is cyclical, unpopular at peaks and troughs, and it sits at the base of the real economy. When the narrative is we're done with oil, valuations can get cheap. If demand stays resilient longer than expected, those assets re-rate.
So what's the non-mystical explanation for buying oil stocks when everyone hates oil?
Cash flow and optionality. Energy companies can throw off cash, buy back shares, pay dividends, and survive hype cycles. Also, in a world where inflation is a recurring visitor, commodities and producers can act as partial hedges. And if there's geopolitical disruption, energy can become the bottleneck again.
The transcript names specific companies and a scenario about access to resources. We don't need to repeat that, but we should translate it into a principle.
Principle. Control of scarce inputs matters. If a sector depends on scarce inputs, oil, copper, lithium, rare earths, then the companies and countries that control those inputs have leverage. That leverage shows up as pricing power, political bargaining power, and for investors, potentially higher risk premia or higher returns for bearing volatility.
Put that into an everyday analogy.
Imagine a small town with one bridge. Everyone can open restaurants, build houses, start businesses. That's the innovation layer. But if only one entity controls the bridge, they can raise tolls whenever they want. The bridge is boring, but it controls the flow.
That's clean. Now, the source material has a strong follow-the-money vibe. How do you do that without becoming a doom scroller?
You turn it into a checklist. Most people follow the money by refreshing social media. That's not following money. That's following adrenaline. A real approach is pick a few indicators, track them weekly, and focus on second-order effects.
Give me a practical starter kit.
Sure. 5 items, once a week. 1. The US dollar index trend. You're not trading it, you're reading global stress. 2. 10-year Treasury yield direction and real yield context. It hints at growth versus inflation fears. 3. Oil and a broad commodity index. That's the cost layer of the economy. 4. Credit spreads. That tells you if lenders are getting nervous. 5. The simple risk-on, risk-off comparison, like global equities versus defensive sectors.
And if those are flashing stress, what do?
You don't panic trade. You check your exposure to fragility. Too much leverage, too many speculative positions, too little liquidity, too much dependence on one storyline. Then you rebalance toward resilience, diversified equities, some quality bonds if they fit your horizon, possibly a modest commodity or gold allocation if it matches your plan.
Let's talk about that gold piece, because it shows up in the transcript. People hear gold and immediately think apocalypse.
Gold is just an unproductive asset that tends to behave differently under certain stress regimes. Currency debasement fears, negative real yields, geopolitical uncertainty. It's not a religion. It's a tool. If you treat it like insurance, you size it like insurance. Small enough that you don't need it to win, but meaningful enough that it helps when other things hurt.
So no all-in.
Almost never. The passive path style is boring on purpose. You want repeatable. You want survivable. A portfolio that needs a dramatic event to succeed is not a portfolio.
The transcript also talks about inflation, oil prices, and interest rates being connected. Can you walk that chain in simple terms?
Sure. Energy is embedded in everything. Transportation, manufacturing, agriculture. If oil rises, shipping and production costs can rise, and that can lift prices across the economy. If inflation rises, central banks may raise rates to cool demand. Higher rates can slow growth, pressure valuations, and shift which sectors do well.
And if oil falls?
Then inflation pressure can ease, giving central banks room to cut rates, which can support risk assets. But it's not automatic. Sometimes oil falls because demand is collapsing, which is recessionary. So you always ask, is this a supply story or a demand story?
That's a helpful filter. Supply shock versus demand collapse.
Exactly. One is inflationary pain with ongoing activity. The other is disinflationary pain with lost income. The portfolio response can differ.
Now let's address the dangerous part of this topic. It's easy to slip into someone is controlling everything.
Yes, and that mindset tends to produce bad investing behavior. Overconfidence, concentrated bets, and constant switching. A healthier stance is, the world is a complex system with incentives. Powerful actors respond to incentives. They protect their interests, but no one controls all outcomes, and uncertainty is real.
So instead of who did it, we ask what incentives are at play.
Exactly. If a country benefits from its currency being the default, it will defend that advantage through policy, diplomacy, trade deals, and sometimes force. You don't need a secret committee for that. You just need self-interest.
Let's make this personal. If I'm a normal investor with a job, a retirement account, and a mortgage, what do I do with all this?
I'd focus on 3 layers: personal finance, portfolio structure, and information diet. Personal finance. Keep an emergency fund. Avoid fragile debt. Don't let your monthly obligations assume perfect stability. Portfolio structure. Diversify across assets and geographies if possible. Don't confuse U.S. exposure with dollar exposure. Many U.S. companies earn globally, but currency and policy still matter. Use position sizing. If you add hedges like gold or energy, keep them in a range that won't wreck you if you're early. Information diet. Stop treating narratives as signals. Use a small dashboard, check it weekly, and make changes quarterly at most, unless your life changes.
That last point is the passive path in one line. Weekly awareness, quarterly action.
Exactly. The best edge most people can build is behavioral. If you avoid emotional whiplash, you capture the long-term compounding that other people donate away.
Let's do a mini case study. Say someone believes the world is moving toward more resource competition and more trade fragmentation. What would a calm portfolio adjustment look like?
Calm means incremental and diversified. They might slightly tilt toward broad commodity exposure or a modest gold allocation as an uncertainty hedge. Energy producers with strong balance sheets rather than leveraged explorers. Industrials or infrastructure themes that benefit from rebuilding supply chains. But they still keep the core as boring index exposure because the base case is that markets adapt.
And what would an uncalm version look like?
All in on one commodity. Leveraged ETFs. Panic buying whatever the loudest account is shouting, or betting everything on a single war outcome. That's not investing. That's stress monetization.
There's another point in the transcript. You don't control what happens, but you can recognize where the chess pieces are moving. Translate that into a practical skill.
Scenario thinking. You write down 3 scenarios: base, bad, and weird. Then ask, if this happens, what assets break? What assets hold up? And what assets benefit? You don't need to predict which scenario wins. You need a portfolio that doesn't die in any of them.
Give me an example.
Base. Moderate growth. Moderate inflation. Normal cycles. Stocks do fine. Bad. Recession plus credit stress. Defensive equities and high-quality bonds may help. Risky credit suffers. Weird. Inflation returns with supply shocks. Some real assets and pricing power businesses can help. Long-duration bonds can struggle.
That's readable. Now, before we close, I want to touch the Buffett angle one more time. People treat smart money moves like magic. How should we think about it instead?
As constraints and patience. Big investors can hold unpopular positions longer and size them safely. They can wait for mean reversion without needing applause. The lesson isn't copy the ticker. The lesson is buy what you understand when it's priced for pessimism and survive the waiting.
And be okay with being early.
Yes, within reason. Being early is only survivable if your position size is humble. A small position can be early. The huge position is just wrong until it isn't.
That's a good line.
Okay, I'm going to summarize the takeaways. 1. The dollar's strength isn't only about the US being good, it's also about global systems that still run on dollars. 2. Crises can strengthen the dollar because demand for settlement and liquidity spikes. 3. Resource control and commodity bottlenecks matter, but we focus on mechanisms, not conspiracy stories. 4. Follow the money means a simple dashboard and second-order thinking, not headline addiction. 5. Invest like an adult, diversify size positions, and use hedges as insurance, not as prophecy. Any final words?
Just this. You don't need certainty to build a strong plan. You need humility, a few reliable habits, and a portfolio that can breathe in multiple climates. If you can do that, you'll be ahead of most people who spend their time arguing about the narrative instead of managing their risk.
Appreciate you. Thanks for coming on.
Thanks for having me. Take care, everyone.